Hello, everybody. It is Hammer with this week's mortgage market update. Here for you for today is October 19th, 2022. I am joined today with one of our vetted VA professionals, Mike Alberico. Did I say that right, Mike? Is it
Yes, you
Alberico?
did.
All right,
Perfect.
cool.
Thank you.
So, Mike, please take a minute. Go ahead, introduce yourself. Tell everybody a little bit about yourself and where you work and all that good stuff.
Yeah, appreciate you having me on. I have been in the mortgage industry since 2012. Next month will be my 10-year anniversary. I have only been a broker the whole time and enjoy the broker channel, enjoy helping people. I think my business is well over 30% veteran. It's really, honestly, my favorite group to work with after being in this vetted VA group since the inception. And I am just down the street from you in Raleigh, North Carolina, where it's a nice chilly day, but we're going to have fun with it.
Yeah, it is. We have unseasonably cold weather here in North Carolina for the fall season. It's actually killing off the foliage. We had a beautiful year going, and now it's all the leaves are falling off the trees real quick. So, but anyway, staying on task. I know what you guys are here for. What you want to do is talk about rates and markets and all that good stuff. So if you're here live, give us a hashtag live, introduce yourself, let us know you're here. If you're a mortgage professional, say hi. If you are a vetted VA member of the vetted VA group and you're a veteran or a spouse of a veteran or any other association and you have any questions, make sure you're a part of the conversation. Ask your questions, share your thoughts. I know that many of you don't make it live. We see a lot of you do watch on the replay. Let us know that you were here, though. Go ahead and give us a hashtag replay in the comments. We do monitor the posts as well. So if you do have any questions, go ahead and ask them after the live session. We'll still answer them for you. And also share your thoughts. Let us know where you're at and all that good stuff. So with that said, let's kind of talk a little bit about where we are with rates this week and where we went from last week and that kind of a thing. And basically for me, I would say rates are probably a little bit higher than they were last week. Mike, would you agree with that? Does that sound right
Yeah,
to you?
not a whole lot. We're not seeing the crazy, jumps like some weeks with the inflation data coming out where we saw like a half point jump, it seemed like, from week to week, but they are a touch higher.
Yeah,
Hopefully
just a touch
this
higher.
is a sign for maybe some leveling.
Well, that's what I was thinking. Today's Wednesday, and I was thinking that Monday, Tuesday, we saw some signs. I'll throw the fancy charts up on the screen for those of you that want to take a look at those. We kind of reference these once in a while. So this is called a Japanese candlestick chart. Forgive me, I've got somebody who wants to go outside, or she's going to meow at us the whole time. So let me let her out in the cold weather, and there we go. So sorry about that. She chose that timing for that. So anyway, looking at this fancy chart. These are called Japanese candlesticks. And when we look at these, we're basically looking at a trend or a path. So I'm going to take a screenshot and show you all what we were looking at and kind of how we anticipate where mortgage rates are going to go. And we've talked about this on some past shows. Mortgage rates, they come from two different sources. I'll use a fresh screen here. And when Mike mentioned he's a mortgage broker, this is where that comes into play. So your mortgage rate really, it's basically two parts. Part number one is going to be the market. And that is where most mortgages are going to end up as being securitized. It's how we keep money flowing into the mortgage market. Otherwise, we wouldn't have enough money to lend. Eventually, we'd run out of money. So what happens is mortgages are pooled together and they're securitized and they're sold as bonds on the bond market. And when we look at these fancy charts here and we see how these bonds are performing and what they're selling for, that dictates the base level of where mortgage rates are going and why. The second piece of your mortgage rate is the lender, and whether that is a direct lender or a broker. We've got a couple different scenarios that you may see. A broker scenario, you may see what they call a direct lender, or for lack of a better term, just so that everybody kind of always thinks of them that way, we'll call them the bank. Because even your bank, like a Wells Fargo, they're not lending Wells Fargo money. They're lending the same money that everyone else is that's actually, has to do with this part over here on Wall Street. So when you add this first part to what the lender has to make in order to make a profit and what we call their margins, when you add that first part to the second part, that's where you end up with an actual mortgage rate as a consumer. So that is your consumer rate. And everybody is affected by this first one. So when the market moves, Mike is affected, Mike's competitors are affected, everybody's affected by that part. And in this market, when you're shopping around, you're really looking at that second part, which is the profits and the margins. And Mike, why, again, not that someone needs to work with a broker, but what is advantageous for you as a broker? Why did you, when you said I've been a mortgage broker that whole time, what is a broker, what advantage does that give for you?
Yeah, so right now I think we're with 16 different lenders that we're partnered with, and it allows us to shop, especially in this volatile market that you're just talking about. Lenders are running different margins right now, so we can price one loan with just say five lenders, and you might see five completely different rates. You might see two that are close to the rate, but the overall cost may be a little different. And it's just that margin factors coming in today. And we're brokers tend to run a little leaner and smaller, where most of our business is self-generated or referral based. Nothing against like the larger guys, but when you see, since you mentioned Wells Fargo, when Wells Fargo's sponsoring the Flyers arena, if they still are, that
Okay.
money has to come somewhere. So a lot of those larger banks that you see advertising, and advertising works. It is what it is. Everybody has different models. I run a smaller model that tends to pass along better rates and costs to the consumer. If a lot of those larger banks and direct lenders do direct to consumer marketing, but that marketing budget is millions of dollars, and that money has to come from somewhere. So that's
Yeah.
why I've always stuck to the broker side. One main reason is I built my referral business with the expectation of certain costs in any market, and I didn't want to change that, because that's how it was. Service plus cost is how I tend to build out my business model, and I never wanted to change that.
So just for everyone to kind of build on what Mike said, and thank you, Mike, for going into that detail. The one thing that we've always emphasized to you guys is that you want to shop around and make sure that you're getting the transaction, the deal, the rate that you're comfortable with. And when you shop around, especially in this market right now where things are volatile, meaning rates will change not just every day from day to day, but they'll change during the day based on what's going on in this bond market chart that I show you over here. That's why when you shop around, you want to make sure you're shopping around at the same time, get quotes at the same time. Today's a great example, and we'll talk a little bit about overnight trading. I'm going to come back to this one for you guys, but I want to tell you guys why you may see rates change from one day to the next. And we're going to come back to this overnight trading topic. So looking here, though, I want to pick back up on the charts here. Last week, we saw rates get a little bit worse. And, what we saw, if you go back, here we are looking at July, right? If you guys look at this where I'm pointing with this arrow, we can see these candlesticks. I want you just to kind of watch that general trend. And as these go down, mortgage rates get worse. If they go up, like what we saw here, this little, just for a few days, you might see a little bit of improvement in mortgage rates. Well, you see that there's been a lot more of a downward trend. And if I take this arrow and put it, we started up here, we look at where we're at right now, that's obviously a very strong downward trend. And that's why we've seen mortgage rates that have gotten continually worse from the end of July to where we're at today in October. Now, specifically though, we haven't seen as severe of a move. And that's because these bonds, I'm going to make a little what we call a range. And the bonds have been kind of working within this range. They weren't moving down as much as they were kind of moving sideways. And day to day, we were seeing rate movement based on how you see these little bars moving up or moving down. But we were still seeing them kind of stay within a range where rates weren't going up, like Mike said, a half a point at a time. But this morning, we saw a big jump, and we saw rates actually move much higher this morning than rates quoted yesterday. Mike, are you seeing that for any rate quotes that you might have done yesterday? Are you seeing that today those rates, that consumer would be getting a higher rate?
Yeah, there's definitely a cost difference when doing a rate to rate comparison, meaning the either buy down points or the lender credit went down a little bit. And
Right.
today was volatile. I mean, I even messaged you before we got on. We started down like, I think, 67 basis points on the MBS. Then we jumped up to only down 30. I was like, asked if this was going to continue. And you said, I don't think so. Now we're back down to, I think, like 55
Yep.
or 60 now. So it's super volatile. And this is just what makes probably the biggest challenge of this market is planning for the consumer.
Yeah.
I mean,
Yeah.
we're in uncharted territories from what I've seen in the doing this for 10 years. Like,
Yeah.
what was it, last Wednesday when the CPI data came out and the stock market opened up like down 800 points but
And
finished
then
up
rallied.
400? It was
Yeah.
that's like insane
Yeah.
for one day movement.
And we'll and I'll tell you a little bit about why. So first, just a quick recap for anybody that may not have seen this before. This fancy chart that I have here. If you'll notice, I have rates on this left-hand column. And like, again, these are just for examples. These are not an offer to lend. These are not real-time rates, but just for an example purpose, if you were looking at a rate of 6.5%, we might call that par, meaning it doesn't cost you any money to get that rate, but you're not getting any credit towards your closing costs. Now, sometimes you may have to pay to get a better rate. So 6.375, maybe that costs you $2,500. And we call those points, discount points that you would pay to discount the rate and get a better rate. Maybe if you were going for 6.25, you would have to pay, say, $3,500, and that would do that same kind of a thing. And then sometimes, depending on who you're working with and the conditions, you may have the ability to take a slightly higher rate and get a credit towards your closing costs. And that way you bring less money to the table, but you'd have a slightly higher interest rate. And that's why when we talk about sometimes where maybe that rate yesterday was 6.5, and today you're still getting 6.5, but maybe 6.5 will cost you $1,000 or $2,000 today. And that's why it may not always be an actual rate movement that we see, but sometimes, when we call it pricing, you'll see actual movement on what you'd have to pay that. Now, the reason that we see that big move between yesterday and today is due to what we call overnight trading, and it shows the global market. So what's affecting your mortgage rates, and why do you see mortgage rates move? Well, if you look, it's kind of hard to see, but if you look yesterday, this right here, this candlestick. And yesterday we ended the day, little tiny line right here, right above this number of about 98.67. And we were up there. What this means is that mortgage bonds were selling for this amount. And I don't want to go too deep on this one, but just when these go down in value, it means that it costs you more to get a mortgage. So we were at 98.67. And this morning we woke up and we were all the way down here, more, closer to 98.10, 98.15. And the reason that we saw that big move, believe it or not, had to do with what happened in the UK. And this is where our mortgage rates here in the United States, they're affected by the global market, by everything that's happening. It's not just what happens here in the US. Now, this is what I call overnight trading, because everything going on in the UK and in the Asia markets are generally happening while we're asleep. So overnight, we saw a big movement where we saw our mortgage bonds lose a lot of value. And we saw the 10-year treasury yield go up. And the yield, when the 10-year treasury yield goes up, that's generally not going to be good for mortgage rates. And again, your mortgage rate is not based on the 10-year value, but it does give you some insight into which direction things are going. And when we were here last week, last Wednesday, the 10-year was at about 3.9. Now it's at like 4.1. And you'll notice that mortgage rates are also higher since last week, because bonds altogether are not doing well. That's pushing rates higher. And we saw this big move overnight because inflation data, just like Mike, you said, our inflation data, our CPI inflation data last week, where bonds lost a lot of ground. We saw mortgage rates take a little bit of a jump when we got that inflation data showing high inflation. The UK also, they got double-digit inflation, and they've got some huge problems overseas right now in England. And as their bond market takes it on the chin, it actually affects our bond market. And that's because of the way that traders are trying to divest, and they put themselves in multiple different, bonds, basically, where they're buying US bonds. And so when these European bonds go up and down, they will also buy and sell US bonds to kind of keep a value there, if that makes sense for everybody. And again, it's an oversimplification, but it kind of gets across on what that's happening. So this morning we wake up, and what does that do for you as a consumer? It means that rates are worse. Your rates or your pricing are worse this morning. And, that's kind of what we've seen happen. And then Mike, you said, like you had talked before, you had asked me, hey, do you think things are going to get better today? And there's really not a lot of reason why we would expect them to get better. We did see some movement better. And for those of you watching, these are some more of these fancy little charts that we're looking at. And this is a line chart. When this line gets higher, that would potentially help improve your mortgage rates. And when things go down, that's worse for your mortgage rate. So we started out with a very big dip down. This is a little dotted line you see here is from yesterday. So yesterday to this morning, we had a big drop down because of what happened overnight. We got a little bit worse in our opening of our own markets in the US, and then things kind of improved before they lost some ground. And there's really not any reason for us to expect mortgage rates to improve from here. The overall outlook for mortgage rates is they're going to continue to creep up. And, I think it's very important that everybody recognize and accept that. They're very much, if you asked me in July, I told you guys, hey, I don't think we have to worry about rates anywhere near the sevens. That's silly. And there's a lot that's changed since July. And that was kind of where I started out my notes this morning, where I was saying that, hey, how did we get here? At the end of July, rates were in the low fives or the high fours. Do you remember that, Mike? Does that sound about right to you?
Yeah, that's really accurate. I mean, even earlier this year, around March, I had to go back and pull a settlement statement for a
Yeah.
previous client, and it was a conventional loan, but it was still in the threes. I mean, that's
Yeah.
just an insane amount of movement inside of a 8-month period.
Yeah. Yeah. And
It's
it has
really hard to
been.
fathom.
And it has been, and I want to give everybody just some quick insight. And I'm watching our time, but why we've seen this move and why we're not expecting rates to move down, because I think it's important for everyone to recognize. I'm just going to put first letters there: April, May, June, July, August, September, October. So I think it's important for everyone to recognize why we think rates aren't going to go down, and that way you can make your decisions. Do you want to be buying a house now? Why would you want to be buying a house now? So in January, rates were much lower, and then they kind of moved up a little bit in February and March. We've got a really big uptick as we went into April, May, June, and then they kind of held through July and actually got a little bit better through July. And we touched on 6% in June when we've got one set of inflation data. That was back on June 10th. So June 13th and 14th were some of our worst rates before this latest trend. And then they got a little bit better coming through the end of July. And then August, September, October, they've gone like this. And the reason that we're seeing this is basically there's two things that are happening. The first one is inflation. And I've talked about this one many, many times. Inflation is what is, at the end of the day, is what is causing our rates to go up. And the reason that we're seeing such inflation is because of COVID. And there's a lot of variables that have to do with that, but it has to do with a lot of the fiscal stimulus, which is the money that the government put in to keep the economy going during the shutdown and during the pandemic. There's monetary stimulus, which is different than fiscal stimulus. Fiscal stimulus comes from the government. It's the government giving us money. That's the payment protection program loans, the payroll loans, payroll protection program loans. It's the stimulus that was given directly, the stimulus checks. It's the extended unemployment benefits. All of that was fiscal stimulus. The monetary stimulus was the Fed. And the federal bank, our Federal Reserve Bank, they dropped rates down to 0% during COVID. And that was the Fed funds rate. Again, they don't control mortgage rates, but they control the Fed funds rate, which is basically a baseline for everything else that's happening in the economy. And when they brought that down to zero, that allowed mortgage rates to get to 2 or maybe 3%, right? So and just a generality, we were seeing mortgage rates that are about 2 to 3% higher than that Fed funds rate. Well, that Fed funds rate today is at 3%. And the expectation, I've shown you guys this chart before, the expectation is that in November, we're going to see it raise rates to 3.75. In December, this is called Fed futures. This is what the markets are currently anticipating and pricing in. We're expecting the Fed to raise them another 3/4 of a point to 4.5. By the time we get into 2023, the first meeting of 2023, there's expectations that they'll be anywhere from 4.75 to 5%. Now, what that does is obviously we've seen mortgage rates that are about 3% higher than this Fed funds rate. So that's why we see mortgage rates continue to go up as the idea that this Fed funds rate continues to go up. And that's why when we look at the expectation, this is why we don't expect to see mortgage rates drop over the next 5 to 6 months, because we expect the Fed to continue to raise this Fed funds rate. And markets have already priced it in. So we're not necessarily going to see mortgage rates go up another, we won't see 8 or 9% necessarily, but we're not going to see mortgage rates go down back into the fives while the Fed is raising rates. Mike, does that make sense? Or is there anything that you would add
No,
to
that
that?
makes total sense. I think the only thing I would add to that is that during COVID, the Fed was by like, I don't know if it good term, an invisible hand controlling mortgage rates, because they were buying up all the mortgage-backed securities and bonds, which was driving this demand for mortgages and keeping the rates down. And then when they stopped purchasing those or even started tapering them, that was almost like a double effect of them raising the overnight exchange rate plus them not driving the market from behind the scenes. And yeah, it's going to be interesting. I mean, I still think it's a great time to buy a house depending on your situation. I did a video on this the other day. If you don't need to move and you're locked into a rate at 3 or less, then maybe if you don't need to move, it's probably not a good time to do it. But if you're renting or if you're relocating for a job, I mean, rent's rent. Rent is going up. If the payment on the mortgage works at that higher rate than we're used to seeing, then by all means do it, because that's a vehicle to get you into a house. In the immediate Raleigh-Durham, Chapel Hill area, which is basically central North Carolina, our values are still continuing to go up. We're not seeing insane appreciation like we were the last 2 years, like 10 to 20% a year, which is really unsustainable. But we're seeing, you're going to see probably between 3 and 6% appreciation. Nobody can ever promise a refinance, but if you can make the payment work, get into the house now, ride out these rates for hopefully no more than 18 to 24 months, come back and refi and get that payment down, rather than, I just saw the question come out earlier, why not wait for rates to go back down?
Why not
Because
wait?
if you're paying 10% more for a house 2 years from now, but you get a lower rate, did you really win? Yeah. And then you just got to kind of stomach the higher interest for a while and build that appreciation. Yeah. But it ultimately comes down to a case-by-case basis. It may not be the best time for someone to buy, but for the majority of the people that I'm talking to, it still is.
And you have to decide, do you want to own a home? And exactly. the reality is nobody wants to buy a house in October of 2022, and in November of 2022, rates go from 7% down to 5%. And what we're here to tell you is that although anything can happen, that is extremely unlikely to happen. And it, basically to the point that I'd put it at 0.0 something percent likely to happen. We would have to see an economic collapse, and your house will be the least of your concerns if we get into that, if we saw mortgage rates go down. Rates are going to stay in this area. And I had that up on the screen of how did we get here? In July, I was telling everybody, hey, we don't have to worry about that. And you know what? We didn't. But here's what was different is, I took it out. There you go. So what I talked about before was we have the inflation and you have the economy. And what happened is that in July, when we were over here, when we saw this kind of area where it looked like rates had capped out back in June, and it looked like, hey, we're okay. We're going to see things settle in. We expected rates to stay in the high 4s to low 5s. At the time, it looked like inflation was coming down and the economy was slowing. That was the expectation. There was a lot of talk at the time of recession, and recession is going to bring rates down when we see a recession. But since July, what changed is that all the inflation reports have continued to show increasing inflation, despite the Fed raising rates in March. And at their, they didn't have that. It was March, April. They didn't have a May meeting, so June or one of those wasn't one. But anyway, at these last 4 meetings, we've seen rate increases, and actually even at the in the September one, we've seen it. So we've seen these rate increases, but they have not tamed inflation, and the economy not yet slowing down. And until we see multiple reports showing that the economy is slowing down, that consumer spending is ending, we're not going to be in a position where rates can actually improve. And we are nowhere near here. I've gone on a couple different trips recently. The airports are full, the hotels are full, people are out there spending money, and maybe it's money they don't have, but they're spending money. And until that economy slows down and until inflation gets under control, we're going to see mortgage rates continue to stay high. Anything you want to add on that, Mike?
No, I think you hit that nail on the head because we were just at our mortgage brokers conference a couple weeks ago in Vegas, and everything was packed. It was like pre-COVID. And the only other thing I will add is it's incredibly hard for anybody, any expert, I don't care what channel you're watching, who you're following, to predict what's happening. People ask me, well, what's the future going to bring? I don't know. All these people 4 or 5 years ago, when rates were actually pretty darn solid and I was locking them in the fours, I go to the close and be like, I'll see you at your next house because you're never going to call me for a refi. Guess how many of those people I refied? Because I told them, I was like, it would take some crazy unforeseen event to
like COVID
drop rates low. It's like it would take World War III or some crazy COVID event, and that's why it's incredibly hard to predict. I mean, it's interesting times, and just reiterating, it goes to a case by case basis depending on what your employment is, what industry you're working in, how's that look for the economic future. It's just really tough times, but lean on people that do this every day. Like we tend to lean on folks on your side with the rate and market analysis to try and predict as best as we can, but that's even challenging.
But there's a lot of volatility, a lot of illiquidity, which again, we talk about that on maybe next week's call. But for those of you that are watching, it's very unlikely we're going to see rates go down much from here. If you're going to buy a home today, you need to be buying a home because you want a home, and you're, accepting the fact that it would have been great. I mean, listen, if there's so many I would haves, right? If I would have known the lottery numbers 3 weeks ago, if I would have known that this was going to happen, if I would have known that rates weren't going to stay there, I would have bought this or done this. But those opportunities, you either got a home or you didn't. You got to look at what you've got now, and maybe in the immediate future. Because I understand people not wanting to make a mistake, but it's not a mistake to be buying a home right now. Mike, you talked about in your market in Eastern North Carolina that prices are appreciating. When we've talked about this with other guests over the last couple of weeks, deceleration versus depreciation. We're not seeing the increases as quickly with 20% year over year value increases on homes, but we're still seeing them increase. And that may stop. I mean, like next month, maybe 2 months from now, we may see home prices come down a little bit. But the question that you have to ask yourself is, why am I buying a home and how long am I going to stay in it? And I can tell you guys that we're not likely to see what we call a market crash. We're not in a market bubble. The reason for that is because, these times are so unique for so many reasons. One of which is, as Mike made a mention before, you have so many people that are in a home at 2 or 3% interest. They're not going to sell that home because they can't afford or don't want to make the move to go to a new home at a 7% interest rate. So they're going to stay in that home. And by staying in that home, that's going to make sure that we're not seeing a lot of homes hit the market. And normally when rates go up, sellers will get a little more desperate because you would have a reduction in demand. So you would have sellers that are coming down in price, and it will kind of get an equilibrium. We're not seeing that necessarily because there's still not enough supply, because people are going to sit on homes because of those interest rates. And that's the factor on why we don't think that we'll see a large depreciation to value. You may see some prices where you buy a house for $300,000 and 6 months from now it may value at $290,000. But 2 years from now, when rates drop again, what happens to that house again, Mike?
Oh, it's going to go back up. And it's like you're saying, like, 08 was, we had too many houses and crap mortgages that should have never been written. Now we still have too few houses, and everybody is as qualified as they ever been. So it's definitely a supply program or problem. And the rates have created more of a supply problem. And you got to look at, if you really want to dive deep into data for anybody watching this, economies are incredibly localized. Like obviously where I live, I pay a lot more attention to other parts, but we're the Raleigh metro area is the fourth fastest growing metro in the US. So that means that we're still adding jobs. Inflation is not immune here. I know just for shopping at the grocery store for my 3 kids, I know that inflation is hitting us, but people are still moving to the area, and that's still going to create that demand for housing. What we've seen is not necessarily a decline in housing costs, but we're not seeing 40 offers on one house that might take that $400,000 house and push it to 475 so people can get into it. You might see that $400,000 house get 2 or 3 offers, and they might go in at asking price, or even, and I'm seeing on contracts, seller pay concessions coming back. Sellers actually willing to negotiate, because it used to be, give us your highest and best. If you want repairs, you want to negotiate, tough.
Just kick to the curb.
Right. Now we're actually seeing negotiations. So if you want to look at the silver lining of what's going on with the rate market and our economy, that it's starting to make it more of a normalized market to where, realtors can actually negotiate like they used to. So that's the silver lining I take from it, and a potential reason to still continue to get out there and look.
Yep. That's really what everyone just needs to realize, that this is today's market. It's not going to change. We're likely to see rates creep up a little bit higher before we see them creep a little bit lower. The reason that I expect to see that is because of what's going on with the Fed funds rate, with the fact that inflation is continuing to be an issue, the economy not seeing any reports that are slowing down, the labor market not yet slowing down. Until we start to see that happen, we're not likely to have to worry about, hey, what if I get a loan today and rates really significantly drop? And I'm talking about more than, okay, I got 7.25 yesterday, and tomorrow they go to 7 1/8, 7.125. I'm talking about getting a mortgage in the 7s and then seeing rates go down to the 5s. It's not likely. You don't want to wait till rates drop. You don't want to wait until home prices come down. They may come down a little bit, but again, what you're waiting for, rates may go up by the time those home prices come down a little bit more. And now you're in even more of a trouble. We don't know the future, as Mike said. We don't know what's going to happen with that. The time to buy a home is when you need a home. And as far as an investment, it is still, home equity is one of the best ways of building wealth, especially generational wealth. So keep that in mind. Mike, anything you want to add before we wrap it up today?
If you're in the market and buying, we always say, where I work, if you like it, lock it. I mean, I lock the entire pipeline. What I mean by that is I lock the rates when they come in. If they go down, the lenders can figure out a way to adjust. It's going to vary from lender to lender, but they'll figure out a way to adjust. I have one outstanding loan that isn't locked, but it's new construction that's not slated to close until March or April. That's really challenging to find a long-term lock in this market. But now is not the time, if you're a consumer, in my opinion, full disclosure, my opinion, to play the market with rates. If the payment works, you find the house, lock it down. You can always adjust down the road.
Yeah. And then, and not that we don't care, but you don't want to major in the minors. I know that $500 is $500, but closing cost difference from one day to the next, by trying to save a few bucks on closing costs, you may wake up like we did this morning and realize, well, now you've lost $2,000 or $3,000 by the time they moved, and all because of something that happened in England. So it is, that is today's environment. It is definitely volatile. That's why when you're given advice to lock, and that's it. So awesome. Well, thanks for joining us, Mike. Remember, everybody, that you guys can join us. We do this each and every week, 12 p.m. Eastern, 11 a.m. Central, 10 a.m. Mountain, 9 a.m. Pacific. If you have any questions, or if you want to go back on anything that we said, if you're watching on the replay, please go ahead and give us a hashtag replay. Let us know that you're here. If you were here live, please let us know that you were here as well. I do see quite a few of you that were here while we were on. So thanks for that. And Mike, any last words you want to leave anybody with, or else I'm going to wrap it up?
No, thanks for having me on. I enjoyed it.
Awesome. Stay on. I'm going to end the broadcast. You stay on for a minute, and then we'll wrap it up. All right. Take care, everybody.